The US economy just got a major update, and here's a hint, it's not all bad news. S&P Global Ratings have reaffirmed America's double A plus credit rating, even with record high debt. The reason why is Trump's tariffs are sweeping through and generating enough revenue to offset the ballooning deficit here in the nation. But as we'll see, that's only one piece of the much bigger puzzle, one that touches housing, retail investors, and the Federal Reserve itself. So let's get into it. Back in 2011, the US has lost its AAA credit rating, and since then we've held at this AA plus rating. Despite a record 37 trillion debt load, S&P says tariff revenues and broad tax intake are helping out, so to say. Just last month, the U.S. deficit hit $291 billion, but tariff collections surged to nearly $28 billion. The Committee for a Responsible Federal Budget projects tariffs could add $2.8 trillion in revenue by 2034. That's still quite out. Still, the CBO, the Congressional Budget Office, warns that Trump's One Big Beautiful Bill Act could add $5 trillion to debt if temporary tax breaks become permanent. Now, in other words, tariffs may be a short-term cushion helping things out, but they're not necessarily solving the structural problem of rising entitlement, costs, and debt services, both alike. Now, Moody's has already downgraded U.S. debt to a AA1, citing unsustainable deficits. S&P warns that if spending continues unchecked, or even if the Fed's independence is undermined or comes into question of concern, a downgrade could likely follow. Foreign buyers, however, remain committed, with $9.13 trillion in treasuries held abroad, with Japan and the United Kingdom leading as in foreign buyers. So the main takeaways here is that the US dollar and treasuries are still the world's safe haven asset, but cracks in confidence could change that if deficits spiral even further from where we are today. Now, let's talk about retail investors versus veterans. So, Fidelity's State of the American Investor Survey shows this fascinating split that I think we need to talk about. So, these younger investors, say 0 to 5 years of investing, are far more bullish, with 56% of expecting portfolio gains next year. Now, there's a heavy reliance on social media for advice these days: TikTok, YouTube Shorts, Reels, 36%. And a big interest in crypto and alternative investments have been making its way in the themes. Now, veterans who are, say, 10 plus years of investing, only 34% expect gains, with nearly half focused on limiting losses, if anything. They've lived through multiple cycles and carry lower risk tolerance. They also have a lower investment horizon, just because they're going to be going into retirement a lot sooner than some of these young investors with, say, 0 to 5 years of investing. So the key point here is that new investors are a lot more optimistic, experimental, and social media driven, while these experienced investors are cautious, defensive, and wealth preserving rather than in these growth stages. Also, there's this Fed pressure still going on. Trump and his Treasury Secretary Scott Bessent have been pressuring Powell for a deep rate cut. We've talked about it for quite a while now, with them urging for this 1.5 to 1.75% of Fed cuts that they'd just love. The White House even released a list of 11 potential successors, including current Fed officials and private economists. But many analysts see it as a more political theater, reality TV show, if you will, designed to scare Jerome Powell into easing policy a lot sooner than a lot of people are expecting. And there's this risk here that a lot of people aren't talking about, and it's undermining the Fed, which brings Fed independence into question, could weaken long-term credibility for the United States, the Federal Reserve, and the U.S. dollar, and as S&P warned, even threaten the dollar's global reserve status, which I don't think a lot of people are considering all of the dominoes that can knock over from that. Not to start bringing out all the scary headlines and spreading fear, uncertainty, and doubt. But let's talk about housing starts data that we got today for July. So July housing starts jumped 12.9% year over year, driven mainly by this multifamily construction, which is up 27.4%. So that's seen as really optimistic as far as the real estate market goes. A lot more projects are starting. Single family starts fell though, with builders cautious to build due to these higher mortgage rates. They've really been fluctuating in the high sixes, low sevens for quite a while, and tariff-driven material costs that are driving costs up for everybody. So although, yeah, this is seen as optimistic for the real estate market in general, the single-family residential space is still struggling, leading to renters staying renters for much longer, fueling apartment demand, which is why we're seeing the builders really focusing on the multifamily that seems to just be printing the moolah right now. Builders remain weary. Permits for new projects are down, signaling uncertainty. Because think about how housing starts are projects that are starting now, and then building permits are more future looking, like, all right, we're trying to get all of our ducks in a row. We're trying to have everything down to the line so we could start on our projects in the coming months. So permits are more forward looking. So the main bottom line here is that apartments are hot, people are renting, but single family homes are still stuck in the mud, and it sucks for them. Home Depot gave out this almost warning as they admit tariffs are forcing modest price hikes on some of its products. So more inflation for us to talk about with the Fed as to why they're not cutting rates, and the inflation gauges showing that in the data possibly. Consumers are beginning to pull back from these, they've been doing this. So consumers are still pulling back on large renovations, kicking the can down the road. They're focusing on much smaller cash-funded projects, and everything that's much larger or needs financed. The financing costs are still pretty high. Tariffs are making the products more expensive. So what we're seeing is that both Home Depot and Lowe's see pent-up demand of to nearly $50 billion in renovations that are waiting for these rate cuts to be unleashed. Now, Trump has extended the China truce through November 9th, and this isn't necessarily the newest news out there, but tariffs remain at 30%, avoiding a spike that could have shocked markets with these big two world superpowers trying to come to a deal and an agreement. Gold was briefly tariffed before Trump reversed course. Now he's exempting it. Meanwhile, Nvidia and AMD struck a 15% revenue sharing deal with the US government for certain chip sales out to China. And what we got here is that tariffs remain Trump's signature economic levers, shaping inflation, trade, and even technology policy. And who really knows where we could draw the line here? But who pays these tariffs? Goldman Sachs says that so far, U.S. consumers have absorbed 22%, set to rise up to as high as 67%. So we're not quite there yet as far as absorbing the cost. So costs have a lot much higher they can go, is what it's sounding like. U.S. businesses absorbed 54%, and they're expecting that to drop to as low as 10% pretty soon. Foreign exporters are currently around 14%, and they're saying that they could rise up to 25% and may be forced to absorb more of these tariff costs. So the translation here is that tariffs start as a foreign paid, but eventually the costs will begin to trickle down for American shoppers like both you and I here in the United States. So the United States economy today is a story of resilience, but also fragility. Tariff revenue is buying time, and debt is climbing, which is one of concern. Investors are split between wild optimism and seasoned caution. Housing is diverging between apartments and single-family homes. And behind it all, the Fed is under political fire with the independence of the Federal Reserve in question. So the big question is, can tariffs, trade, and rate cuts keep this economic engine chugging along? Or are we setting up for more turbulence ahead? I'll let you comment that down in the comments below. Be on the lookout for the next video, y'all, and I'll see y'all tomorrow.